Our market master of the day is with us. Hiren Ved, the CEO, Director and CIO at Alchemy Capital Management. Hiren, great to have you with us here. Thank you very much for your time. Hiren, first of all, do you believe that the bottom for the market is already in, and it's a much more constructive environment for stocks from here on? What's your view?
Good morning, Prashant, and thanks for having me on the show. I certainly believe that the correction that we saw in May and June is probably it, and I think from here onwards, we're pretty constructive about the market, and I think the single most reason for that is that despite all the macro headwinds that we've been all talking about, I think earnings in India, by and large, have held up reasonably well. And to have two back-to-back years of very strong earnings growth, and if you look at the next 2 years out, I think Nifty can still deliver mid-teen earnings growth, which means that after a very long period of time, India's earnings growth cycle is fairly robust. And I think that, to me, is the single most important reason why the Indian markets are fairly resilient in relative terms and even in absolute terms. So I have no doubt that I think the markets will do phenomenally well. There could be small phases of consolidation, but that's, par for the course.
Okay. Hiren, good morning. So the market's leadership has changed, though. It's moved from IT to banks this year, and especially this month. What's your view? Will financials sort of lead this market from here on?
Well, I think if you look at the large sectors, Anuj, I think financials should lead the market from here onwards. I think credit growth has moved up reasonably sharply. We've seen fairly good numbers. I think NIMs are expanding for most of the banks, and a higher interest rate scenario actually brings pricing power to banks which have a very good liability franchise, right? But I think even within the private sector banks and financials, I think that the leadership sweepstakes are clearly changing. I think ICICI Bank, to my mind, clearly leads both HDFC and Kotak in terms of consistency of performance across all parameters, as well as growth, right? So I think that while banks will lead, but the pecking order is changed as compared to what it was pre-pandemic. And I think that, that's an area where incrementally, also within the Nifty, you will see the largest delta in earnings, which is in the financials.
It's interesting. So you're saying that if ICICI Bank is leading over peers like HDFC Bank and Kotak, does it make sense to top up on names like ICICI Bank now?
Absolutely. I have no doubt. I think that the pecking order has clearly changed. Not to say that HDFC and Kotak are not great franchises, but I think that, in the case of HDFC, earnings growth is slowing. Plus, they will have to really work hard to increase their liability side to absorb HDFC Limited and the uncertainties around the merger. And I think that both Bajaj Finance and ICICI Bank, if you look at their performance of these two stocks post-COVID into the run-up over the last 2.5 years, I think very clearly they have beaten their peers hands down. And I think that clearly shows that these two large financials have leadership with them.
Okay, sorry, that's on banks that you mentioned. Just had a follow-up, since we're talking about some of the big stocks that are moving, right? Today, Tata Steel is in focus. After very long, we're seeing a really strong performance coming from Europe. But this is a stock that has disappointed hugely. I mean, it's down 40% this year already. Do you think fortunes can change, or would you give it a pass?
Well, I think, Sonia, it's very, very difficult for people like us to be long-term constructive on commodities, right? I mean, in short spurts, there is always an opportunity to make money. But To make money in deep global cyclicals, you got to get the timing absolutely right. We did play one cycle last year, both in Tata Steel and Hindalco, and now we've broadly exited these two. I think given the uncertainties around global growth at this point in time, it is extremely difficult to take a call on these businesses. So while they've delivered better than expected numbers given the way margins have panned out in Europe, I think there are better structural plays at this point in time in India, uh, where I think there is clear visibility for growth and there is not that kind of volatility. I mean, you have to literally play a quarter to quarter game. That's not really what our objective is, especially with the kind of strategy and the money that we manage.
Okay. Hiren, just coming back to you, market is now down more decisively. It's down 85 points on the index. And just looking at a bunch of other names here, Zomato, of course, is at 45. It opened there for 5.5 lower. Vedanta is down 6%, full 6% now, 242 on Vedanta. Infosys is down 1.5%. It's coming up as one of the top losers. Tanla Solutions, we detailed the numbers earlier as part of our top 10 list. It's down 16%, Tanla that is. There is Adani Green, which is down 2%, coming up with volumes. There is Yes Bank, which is down 2.5%. HCL Tech, L&T Technology Services, both are down 1.33% and 2.5%. There is Persistent, Emphasis, lots of Sonata Software. I mean, I'm kind of jumping names here, but they're all in the mid-cap tech space. And of course, a leader like Infosys is also losing a little bit. Market breadth, of course, is about 400 stocks more in favor of declines right now. Hiren, your thoughts on IT services, the large 2 or 3 names, and of course, I mean, the entire mid-cap IT space, if valuations come off adequately, if you have time on your side?
Well, I think we have been fairly constructive on the IT space. It was the best performing index post-COVID. Having said that, I think within the IT space, we are very clear that we want to be invested in structural growth stories which are in the ER&D space. And if you even look at the numbers this quarter that some of these companies have delivered, right, I think they've done a far better job than the frontline companies. I think overall, having said that, I still believe that while some returns can moderate from here onwards for the large cap tech companies, given that growth will not be as robust as it was in 21-22, but I think that some of the slowdown in the top line over the next few quarters will get compensated by improving margins as some of the supply side issues get resolved over the next few quarters. So I think on the whole, it's, we particularly have a preference over mid-cap ER&D tech companies, which we think are in a structural growth phase rather than investing in the large cap IT space at this point in time.
Okay, Hiren, the space which has made a bit of a comeback over the last couple of days is specialty chemicals. Do you have any of these stocks in your portfolio? And I mean, it's been a structural story for last 7 or 8 years. Do you think that can continue?
Absolutely. I think that, if I were to look at the markets today, right, I mean, I think that there are 4 structural themes that we are playing. One that I just mentioned, which is the ER&D software companies within the overall software space. Second is the specialty chemicals and the CDMO, both across pharma and agrochemicals. The third is consumer discretionary. So all your opening up plays, including QSR, liquor, and retailers that we own. And then lastly, financials. These are, I think, 4 structural growth areas. And I think specialty chemicals is still relatively a young industry, just like the generic pharma industry was in the 90s. I think many of these companies will reach significant scale over the next few years. They are all expanding capacities. The return ratios are good. Yes, there could be interim margin volatility in these companies, but I think the more specialty oriented companies should do reasonably well over the next few years. And Also, I think we saw a fair bit of valuation correction in these companies. I think from here on, there should be a reasonable opportunity to grow.
Okay, by the way, one of the stocks of the moment is Tanla platform. Just pull up that chart. The stock is now down almost 20%. Yes, the numbers were weak. It was a disappointing quarter. The revenues declined for the second straight quarter. It was down about 6.5%. But does it deserve a 20% fall? I'm not too sure. In any case, the market is in a mood to sort of punish numbers which are weak. Even Zomato continues to fall as well. So, all these vulnerable stocks continue to see bigger cuts. But Hiren, since we're talking about vulnerable names and perhaps earnings disappointments as well, what did you make of Reliance? Yes, some of its consumer-facing businesses are growing very well, but the numbers yesterday disappointed on the bottom line. There is a lack of clarity on what the upsides for the stock could be in the near term. Your own thoughts?
So I think we do own Reliance, and I do believe that they did a reasonably good job in both retail as well as geo. I think the uncertainty comes from the fact that the margins are being capped with the extra tax that has been put on the refining margins. And I think unless and until that is clearly lifted, right, I think it's difficult for the stock to move in the near to medium term. Having said that, I do believe that Reliance is in a strong growth phase, and all the businesses continue to add value. There is obviously the option value of how they could roll out their green energy business. It's still very, very early days, so difficult to comment on that. But I think their capital allocation is in the right direction, and hopefully over the next few years, they should be able to create value like they have in most other divisions that, most other revenue lines that they have over the last several decades.